Hello everyone, welcome to the 131st episode of me learning how to trade in Forex. So in the last episode we went through, reread through what is Forex and how does it work. So we made some more detailed notes regarding this page. What is Forex trading, beginner's guide to Forex, learn currency trading 6 steps, Forex trading essential for beginners, what is a Forex pair, what are the base and quote currencies, what is a pip in Forex, what is a lot in Forex, how does Forex trading work, what does it mean to buy or sell currency pair, what is a spread in Forex trading, what are margin and leverage in FX trading, why do people trade Forex, got the different types of trading styles. Hedging with Forex, seizing opportunity 24 hours a day because the market is open 24 hours a day. Learn how currency markets work, what moves the Forex market, supply and demand, central banks, interest rates and carry trades, fiscal policy, international trade, and news reports and market sentiment. How to become a Forex trader. So we've got 3 trading styles, spot Forex trading, 3 trading, ways. Spot Forex trading, Forex or currency forwards, Forex or currency options. What is a Forex broker? Discover the risks and reward of trading Forex. And then we got the free courses. And then we went through some of the Forex trading tips for beginners suggested by IG. So determining your risk per trade. Don't overtrade. Cut your profits and let your losses. Cut your losses and let your profit run. Always use stop loss orders, aim for trades with a reward to risk ratio of at least 1, calculate position size correctly, be cautious with leverage, avoid greed and use trailing stops to secure profit. So read through all of this. Yeah, so now since IG.com has some free online trading courses that are available for us to read through, that's what we're going to go through. So there's 3 levels. I guess we just start with the beginners because we're going to go through them all anyway. So introducing the financial markets. Course overview. Ideal as a first step into the world of trading, this course takes you on tour of the financial markets, including shares, indices, and Forex and commodities, equipping you with the essentials every trader needs to know. You'll discover how each market operates, what drives it, and most importantly, how you might capitalize on its movements. But before that, we'll answer the most fundamental question of all. What is financial trading and why would you want to do it? So time, 85 minutes, level beginner, benefits, short, easy to digest lessons, practical and interactive exercises, engaging videos and graphics, free demo accounts, quiz to check your understanding. Yeah, let's go then. So, lesson 1 of 10 in introducing the financial markets with what is financial trading. Carry on. So this is IG. I think it's what we put. IG, yep. And this is what is financial trading. Date is the 10th. Alright, let's get started then. Introduction. When you first start looking into... before that, let's do this. I forgot to do this. Okay. Introduction. When you first start looking into it, financial trading can be confusing. You're likely to hear a lot of jargon surrounding it. Some fairly recognizable, such as interest rate, broker, commodity, or dividend, and some you may never have heard before, such as long strangle, EBITDA, or Ichimoku clouds. However, beneath all the terminology, there's one core principle that underpins financial trading: predicting whether something will go up in price or down. Get it right and there's opportunity for great rewards, but get it wrong and you could lose a lot of money. The one core principle of financial trading: predicting whether something will go up or down in price. That's where we come in. The purpose of our trading academy is to take you through financial trading from first principles. The more information you have, the less likely you are to make costly mistakes. And our goal is to provide you with all the knowledge you need to start making informed trading decisions. We're going to be looking at what, where and how you can trade. We'll teach you how to look out for trading opportunities. We'll investigate how to manage your risk, and we'll look at what techniques the professionals use to become consistently profitable traders, and much, much more. But before we do all that, let's address the fundamental question about financial trading. What exactly is it? What is financial trading? Very simply, financial trading is the buying and selling of financial instruments. So, financial trading is the buying and selling, whoa, why is it so laggy, of financial instruments. These instruments can take many forms, but some of the main categories are shares, small units of ownership in a company such as Apple, Google, HSBC, indices, the value of a group of companies represented as a single number, e.g. the FTSE 100, S&P 500, Nikkei 225. Forex, global currencies including the pound, dollar, euro. Commodities, physical assets, raw materials and agricultural products, for example gold, oil, corn. So, financial instruments can take many forms, but these are some of the main categories. So shares, small units of ownership in a company. Indices, value of a group of companies. The value of a group of companies represented as a single number. Represented as a single number. Forex, global currencies including the pound, dollar, euro. Global currencies. Commodities, physical assets, raw materials and agricultural products. For example, gold, oil, corn. People and companies often trade financial instruments because they need the assets for themselves or their business. For example, you may be traveling from Europe to the USA and want to convert euros to dollars. To do this, you would participate in the Forex market. Or a laptop manufacturer might need a large shipment of aluminium to build components for its computers. When buying the metal, the firm will be participating in a commodity market. However, most of the time, financial traders don't need the asset at all. They're simply looking to make a profit from the movements in price, for example, by buying low and then selling high. Got a cheeky video here.
Financial trading, two simple words that cover a world of opportunity. Like all trading, it's about the exchange of ownership, the buying and selling of financial instruments. Cash instruments like shares, currencies and bonds, or derivatives such as CFDs, futures, options, contracts that get their value from an underlying asset. Now, whatever the instrument, the idea is always the same, to benefit from movements in price. If you buy low and sell high, you profit. Sell lower than you buy, and you make a loss. Sounds simple enough, but there are millions of individuals, companies, institutions, and even governments all trying to profit at the same time, meaning prices are always on the move. And the bigger the movements, the more volatile the market, which can provide more opportunities to profit, but also increase risk. Financial trading is normally carried out in one of two ways: via an exchange, a highly organized marketplace where members trade a specific kind of instrument. For example, US shares on the New York Stock Exchange. Or over the counter, where trades are made directly between two parties, like when you trade currencies at the airport or buy and sell CFDs from your provider. Then there are different kinds of trader. Some stick to a particular instrument or asset class. Others have more diverse portfolios. Some like to immerse themselves in research, scouring the news and financial reports to find their next trade. Others base their decisions on statistical trends. Some take lots of short-term positions, opening and closing trades in a matter of days, hours, and even seconds. Others take a more long-term view and hold assets for months and years. But all traders share one thing in common: risk. It's essential to balance the potential for profit with the possibility of loss, because that's what financial trading is all about.
Okay. Very nice and short and sweet video. What are the financial markets? Just like any other form of markets, financial markets are where buyers and sellers come to trade. They are often physical locations where traders meet to exchange a certain type of asset, e.g. shares at London Stock Exchange, commodities at the Chicago Mercantile Exchange. But they also can be electronic systems, such as the Nasdaq Stock Exchange, the Forex market, essentially a network of large banks and currency providers. We'll look at the different types of market in more detail later in this course. Financial markets enable traders to exchange assets quickly and easily because all buyers and sellers are in the same place, sometimes literally, sometimes electronically, sometimes both. They also tend to have very strict rules and regulations, which helps to reduce fraud and illegal activity. For example, if you want to purchase some cotton on a regulated commodity exchange, you could buy it without needing to inspect it, safe in the knowledge it had been through a number of quality checks beforehand. Did you know, despite the number of variety of different financial markets, when people refer to the market, they usually talk about the value of stocks and shares. If the market has gone up, then on average, shares are performing well. This is because share trading is the most widely known and understood method of participating in the financial markets. Lesson summary: financial trading is the buying and selling of financial instruments. There are many types of financial asset, including shares, indices, forex and commodities. Most of the time, financial traders don't want or need the assets, they trade to make a profit. Financial markets are where buyers and sellers come to trade. The markets are regulated to reduce fraud, keeping transaction costs low and improve efficiency. Yep. So, on to the next one. Why trade? Imagine that one day you decided to put all your savings under the mattress for safekeeping. If you then forgot all about that money and left it alone for a year, it wouldn't have grown. There will be exactly the same amount of money as you put there in the first place. In fact, in real terms, it will probably be worth less than when you put it in there, because the cost of living is likely to have risen in the interim. Shares go up and down, cash down, commodities go up or down. So it seems like cash would always be decreasing in value as time goes on. Now imagine you had instead used that money to buy financial assets such as shares or commodities. Instead of lying dormant, your money would have a much greater potential for growth, as the value of those shares or commodities could go up, though of course there's always the risk they could drop in value as well. Trading the financial markets is all about balancing that risk of the potential rewards, and picking assets likely to move in your favour. As we'll see, if you do this sensibly and intelligently, the rewards could be much higher than simply letting your money sit in a bank account or under the mattress. So trading the financial markets is all about balancing the risk with the potential reward. And picking assets which are likely to move in your favor. Investing versus trading. What we've described above is called investing, essentially a long-term form of financial trading which involves buying and holding financial assets over a number of months or years. In fact, it's quite likely that you already investing in the financial markets in some capacity, possibly only passively. If you have a pension plan, for example, then you're investing the money you're earning now with the expectation it will grow and be worth more when you retire. Pension firms generally invest this money for you in return for a management fee. In most cases, however, you can have a say in which financial instruments you put your money into. And as the chart below shows, a few simple decisions now could have a dramatic effect in the future. Value investments, 1986 to 2014. So 1986, they all pretty much start at the same point. We can see that UK equities, compared to just the normal pound sterling, has risen massively. So, yeah. Looking at the chart, you can see that £100 saved in the cash in 1986 would be worth just £38 in 2014 due to inflation. Oh, this is right, okay. If you had invested that £100 in the UK stock market, you could have received a return of around £1,120. But long-term investing isn't the only way of participating in the financial markets. There's also active trading, sometimes known as speculation. While investors generally focus on the long-term value of assets and attempt to build a portfolio that will perform well in the future, active traders tend to focus on short-term market movements, with some participants placing hundreds of trades per day. So, investors generally focus on the long-term value of assets and attempt to build a portfolio that will perform well in the future. Active traders tend to focus on short-term market movements. Whether you choose to focus on the long game, making only a few trades per year, or whether you believe that every tiny movement in price represents an opportunity is entirely down to you, your personality and how much time you can devote to trading. We'll look at this topic in detail in the planning and risk management course, but for now it's important to note that there are many different ways to trade and many different types of trader. And whatever your interests, skills or priorities, there's always a form of trading that will suit you. One of the main differences between traders is the type of assets that they trade, and that's what we're going to start looking at in the next lesson. So, lesson summary. Financial trading provides the potential for your money to grow, but there's always a risk you can lose money as well. Investing focuses on the long-term value of assets, and active trading focuses on the short-term movements in prices. Okay. What are shares? When you hear people speak about trading or investing, most likely they'll be talking about share trading. It's one of the most popular and most traditional ways to trade the financial markets, particularly among individual investors. As we saw in the previous lesson, if you've got a pension plan, the chances are you're already investing in shares in some capacity. But what are shares and how do they work? So we've got the triangle, total company value is the triangle, one share is that little bit of a triangle. A share is a unit of ownership in a company. A share is a unit of ownership in a company. I've got to say, these are some really nice diagrams. Really clear as well. So if a particular company is worth £10,000 and has issued 2,000 shares, each share would be worth £5 because 10,000 divided by 2,000 is £5. As the share price fluctuates, so does the value of the company. Investors who buy shares in the company are hoping it will grow in value, enabling them to sell shares at a higher price. Investors who buy shares in a company are hoping it will grow in value, which enables them to sell the shares at a higher price. Question: Company ABC is currently worth £1,200,000 and 3 million shares have been issued. How much is one share worth in pence? So that's just, let me get my calculator out. Where's my calculator? There we go. So that's just 1, 2, 1, 2, 1, 2, 3. So 1,200,000 divides 3 million. 0.4. 0.4 pounds, that's 40 pence. Yeah, 0.4 pounds or 40 pence. Why do companies offer shares? To raise money. By allowing investors to buy part of a company, the management are able to raise capital to put back into the business. For example, they may need extra cash to expand into other territories or launch new line of products. If the funds are used wisely and the company becomes more profitable as a result, the value of the share price and therefore the business should rise. This means the company and its shareholders are heavily reliant on each other. The company needs shareholders to raise funds, and the shareholders hope the company will use their investment to grow the business so they can make a profit. Okay, so it's like, is it symbiotic? Where they mutually benefit each other? Okay, so companies offer shares to raise money. By allowing investors to buy part of the company, the management are able to raise capital to put back into the business. If the funds are used wisely and the company becomes more profitable as a result, the value of the share price and therefore the business should rise. Why do share prices move? Share prices can stay fairly stable for months or move rapidly. The amount a share fluctuates is known as its volatility. Whether a share price moves up or down is based fundamentally on the laws of supply and demand. Essentially, if more people want to buy a share than sell it, the price will rise because the share is more sought after. The demand outstrips the supply. Conversely, if supply is greater than demand, then the price will fall. Whether a share price will move up or down is based fundamentally on supply and demand. If there are more people trying to buy the share instead of selling it, then the share price will rise as there is a greater demand than supply. If there are more people trying to sell the share instead of buying it, then the share price will fall as there is a greater supply than demand. Yeah, look at these diagrams, they're so crisp and clean. Oh my god. Right, okay, do that. How levels of supply and demand move prices. Supply and demand can be influenced by many factors, but the main two are earnings. Supply and demand. Supply and demand can be influenced by many factors. The main two are earnings. These are the profits a business makes. If the earnings are better than expected, the share price generally rises. If the earnings disappoint, then share price is likely to fall. Companies tend to release earnings announcements for a specific time period, usually a quarter, half, or full year. The firm's share price can be particularly volatile immediately before and after the announcement, especially if the figures are significantly better or worse than expected. You can use an economic calendar to see when certain companies are releasing earnings results. The profit the business makes. If earnings are better than expected, the share price usually rises. If earnings are disappointing, the share price usually falls. Companies tend to release earning announcements for a specific time period, e.g. quarterly, half or full year. The company's share price can be particularly volatile immediately before and after the earnings announcements. Okay, sentiment. This is perhaps the most complex and important factor in a share price. Share prices tend to react strongly to expectations of the company's future performance. These expectations are built on any number of factors such as the upcoming industry legislation, public faith in the company's management team, or the general health of the economy. So share prices tend to react strongly to expectations of the company's future performance. These expectations can include upcoming industry legislation, public faith in the company's management team, or the general health of the economy. So, lesson summary. A share is a unit of ownership in a company. Companies offer shares to raise money, usually to invest back into business. Share prices are influenced by supply and demand, earning figures, and market sentiment. Trading shares. How are shares traded? Most major shares are traded on the stock market. This is a general term for a global network of specific exchanges where shares are bought and sold. Most major shares are traded on the stock market. This is a general term for a global network of specific exchanges where shares are bought and sold. For example, the majority of UK shares are traded on the London Stock Exchange, while most of the US shares can be found on the New York Stock Exchange, or NASDAQ. These exchanges are highly regulated marketplaces where buyers and sellers come together to negotiate the transaction of shares. Only certain qualified individuals are allowed to trade physically on the exchange itself, so investors generally need a stockbroker to act as a middleman. Select the country for the following exchange: LSE, UK, London Stock Exchange, BME. Spain? I don't know actually. Okay, Bolsa de Madrid, Spain. New York Stock Exchange, that's USA. TSX. That's either Canada or USA. I'm going to say it's Canada. Toronto Stock Exchange, okay. Cool. What is a stockbroker? The role of a stockbroker is to buy and sell stocks on their client's behalf. Traditionally, an individual investor will need to call up the broker, who will then relay the trading instructions to a qualified dealer on the exchange. Nowadays, however, this process is almost always conducted online. There are three main types of broker. Stockbrokers buy and sell stocks on their client's behalf. there are three main types of broker. So we got the full service, create and execute strategy based on investment goals of the client, trading on their behalf. So they create and execute a strategy based on the investments on investment goals of the client, trades on their behalf. So they do the trading for them. High commission. Advisory. Provide investment advice and recommend specific trades, but leave the final decisions to the clients. Provide investment advice and recommend specific trades, but leave the final decisions to the client, to their client. Medium commission. Execution only. Simply carry out the client's trading instructions, usually via online platform. No advice given. Carry out the client's trading instructions, usually via an online platform. No advice given. When choosing a broker, it's important to consider your knowledge of the markets as well as the amount of time you're prepared to commit to watching your portfolio. When choosing a broker, it's important to consider your knowledge of the markets as well as the amount of time you're prepared to commit to watching your portfolio. Trading times. Shares are only traded during the opening hours of their designated stock exchange. Here are the opening and closing times of a few major exchanges. UK time April to October. Opening times will be different throughout the rest of the year due to the local daylight saving time changes. So LSE, London Stock Exchange. I'm assuming that's... Where's that? Is that 9 o'clock or 8 o'clock? I can't... 8 o'clock's in here, so 9? 9 till... So that line's 8, right? 8 till half 4, is that right? LSE, that's London Stock Exchange. Euronext, Amsterdam, Brussels, Lisbon, Paris. So got the same time as the London Stock Exchange. TSE, ASX, Tokyo Stock Exchange and the Australian Stock Exchange. And the New York Stock Exchange is here. Hong Kong Stock Exchange is over here. Australian stock. Yep. Okay. How do shares become listed on exchange? Companies are either private owned or public. Privately owned or public. A private company isn't listed on a major stock exchange, so you would usually have to contact the owners directly to buy shares. Even then, they're under no obligation to sell them. A private company isn't listed on a major stock exchange. So you have to contact the owners to buy them. Directly to buy shares. However, if the owners want to go public to raise some capital or boost the company's reputation, they must carry out initial public offering, or IPO. Following an IPO, the company's shares are listed on the stock exchange and ordinary investors can buy and sell them. Publicly listed companies often have many more shareholders than private ones and are subject to much tighter regulations. The exact rules tend to differ depending on the exchange, but generally a public business needs to appoint a board of directors and disclose detailed financial information at least twice a year. If the owners want to go public, they must carry out an initial public offering. Dividends. A key advantage of investing in shares is the potential for dividends. A dividend is the amount of money paid to shareholders representing a portion of the company's profits. Dividend. An amount of money paid to the shareholders which represents a portion of the company's profits. Very nice diagram again. So, company's profits is that, dividend to shareholders. Portion, so this is the portion of a company's whole profits, and then each the little triangle is divided to each shareholder. When a company makes a profit, the management get to decide how much to put back into the business and how much to pay to shareholders as a dividend. Dividends can compensate for a share price that isn't moving much, giving shareholders an income instead. Companies that are expanding rapidly usually doesn't offer dividends, choosing instead to reinvest all their profits to sustain growth. The reward for shareholders in this case is a higher expected share price in the long run. So when a company makes a profit, the management get to decide how much to put back into the business and how much to pay to the shareholders as a dividend. Dividends can compensate for a share price that isn't moving too much, giving shareholders an income instead. Rapidly expanding companies usually don't offer dividends, as they would reinvest all the profits to sustain growth. The reward for shareholders in this case is a higher expected share price in the long run. So, lesson summary. Most shares are traded on major stock exchanges. Investors generally need to act through a stockbroker to trade them. An initial public offering is the first time a private company offers its shares for sale to the public. A dividend is a portion of the company's profits. Okay. I'm going to leave this episode here then. So in the next video, we're going to carry on with introducing the financial markets with what are stock indices. So thank you all for watching, and I will see you guys in the next video. Peace.